Another thing I'm very bullish on as far as the next 2 to 3 years at least is this idea of residential real estate picking up. Like extremely controversial, not like controversial like people are gonna get mad, but like controversial like in the sense, what are you thinking kind of thing? Like,
Yeah.
have you been paying attention the last 10 years? But if you look at the numbers as far as what the government has with personal balance sheets, people have stronger personal balance sheets than they ever have. The disposable income is very high. And then you have millennials, and that's a demographic that's just shifting into this first home buyer range. And you know, they're a little bit later than previous generations as far as home formations and everything like that. But they're still in that range where you are likely to see a lot of first time home buyers, and that kind of cascades through the whole residential real estate industry. Obviously, with everything that happened last year, huge booms, but it seems like the narrative is that was just specific to the pandemic and it's not really going to continue after that. I disagree. And so I find that plus some other reasons why I'm very bullish on that theme. If you find something, I think like as a value investor, I mean, you're called the Intelligent Investing Podcast. So I'm assuming you talk a lot of times about buying with a discount to intrinsic value.
Totally.
Is that fair?
Absolutely. Yeah.
So it's a fantastic philosophy and I subscribe to 100%, but there's a lot of danger in that because a lot of times there are reasons why these companies are beat up. Mm-hmm. And so you do have to turn over a lot of rocks to find something that's beat up and still a good value. Though obviously I love doing that and I love to fall in love with the numbers, I have to understand what's the narrative. Why are these stocks this cheap? And so if you can conquer that, then you have a much better chance of understanding why the valuation is there. And then you have a counter argument to this is why I think the free cash flows will be better than what is being priced into the market now. Let's talk about Griffon GFF. This is another one. They're up like 15%. And so something to kind of look at if there's another pullback. But basically what they do is they do two main things. It's garage doors and they do gardening equipment. Last year during the pandemic, people were going crazy. I don't know if you ever drove by like a Lowe's or a Home Depot.
Of course, yeah.
And it was like going to Disneyland. You know
I know,
what I mean? Like,
wild.
Every single time I was like, how come I don't have stock in either of those companies? Very frustrating. But I think the narrative behind why so many people were there is because there's nothing else to do, which I think there's a lot of truth to that. But also the residential real estate market at that time was just on fire and people were putting up homes and they were being sold really, really quickly. And so what happens when people move up in home or move down in home, they'll do a lot of remodeling and they'll try to really upgrade that value of their house. So that works well for garage doors and also works well for gardening just in general. And then you move across the country and you need brand new lawnmower, brand new shovel, brand new, all of that. You're going to need a bunch of tools. And so this is a company where the narrative says, hey, this was kind of a one-time thing. The demographics and a lot of the other statistics kind of show, well, maybe this is something that's more long-term. And so a company like Griffon, as an example, and why it shows why digging deeper is a good idea and a way you can do it. And I guess it's a good metaphor because they do sell a lot of shovels. They have good free cash flows. That's pretty obvious when you look into the numbers. Mm-hmm. Something that creates pause and makes you think maybe it's not a company I normally want to buy is that their net debt to EBITDA was a bit high, like higher than I feel comfortable with. Because I talk about margin of safety, emphasis on the safety. Mm-hmm. So for me, I like low leverage, and they had a lot of it. And the interest expense is not insignificant. It's
a real expense.
Yeah. And it kind of was looming in the 10K where you're like, oh, I don't really like the look of this. But then a couple of months before I got into the company, they just refinanced, taking advantage of all these super low interest rates. And now they don't have any principal payments until 2028. And so on top of the fact that it was trading pretty cheap, it's got these great tailwinds. It's got a good track record of growth. And, you know, there is some transition going on with some other business segments, but it seems like there's just a lot of good things going for it. And that idea of looking at things like debt covenants, which are super buried down in deep into the 10K, and looking at something like a refinance that they just did, looking at new bond issuances, all that kind of stuff. You can find different gems that just look a lot more attractive when you look at what the reality is versus what a number might show on a website with, well, they're more highly leveraged or they have this much debt. That's kind of an example I thought that I really liked. of digging under, finding some rocks and finding value in that.